Hello, all, and welcome to the Forward Thinking Financial Planning webcast. We're going to begin in just a few short moments, but before we do, I'd like to remind all attendees that they're currently in listen-only mode, but to please feel free to ask questions at any time, and Scott will answer them during the live Q&A session at the end. With that, I'd like to hand it over to Scott Crawford.
Hello, and thank you for attending today's webcast. I am Scott Crawford. I'm a partner in the national outsourced or fractional CFO firm, Preferred CFO. We're a CEO Coaching International strategic partner, and we have a lot of respect for this world-class organization. Over the last couple of years, as we have visited with many clients of CEO Coaching, we have seen firsthand the impact that their coaches and their strategies have. This has got to be the question of the day. How do you feel confident, or do you feel confident in your outlook for the economy? So who feels like they have a good handle on what's going to happen in our economy over the next 10 years? Or how about the next 3 to 4 years? Or how about even the next 12 months? And then personally apply the same questions with respect to your business, not just the national or the international economy. Nearly daily, we hear of both record company profits and also corporate layoffs. Last month, CEO Coaching hosted a webinar wherein they detailed many of the cutbacks being made by companies such as Peloton and Netflix. Last December, it was announced that Apple was paying out surprise bonuses of as much as $180,000 to software engineers in a bid to stop employees from fleeing to other tech companies. However, yesterday, Apple announced they intend to slow hiring and spending growth over the next into 2023 in some units in order to deal with a potential economic downturn. However, they are still planning an aggressive product launch schedule in 2023. One of the many economic analysts that we follow is ITR Economics. They have repeatedly said that they expect a depression in the 2030s and have actually now moved that date up to 2029. But they also believe that there will be a significant expansion or significant opportunities over the next few years. With what you are seeing, are you and your business in expansion mode or in hunker down mode? Whatever mode you are in, what are you doing about it? And with all the data that's available, is any of it telling you specifically how it applies to your business? This broadcast is entitled Turn on the Headlights, or Turn on the Financial Headlights. Whether you're in expansion mode or hunker down mode, you need to turn on the headlights. I want to share with you some ideas how you can turn on the headlights and see the road ahead. I frequently ask companies to imagine they're driving on a mountain road in the dark without good headlights. What happens when a deer jumps out? It's not a big deal if you're doing 5 to 10 miles an hour. However, it's a huge deal if you're going 60 miles an hour. And perhaps think of miles per hour or speed as revenue or equity or assets, whatever you have in play or at risk. You need to have the high beam headlights to be able to see the deer before it jumps onto the road. Otherwise, there's a strong potential for a catastrophic event. It's the same in business. You must be able to see what's in front of you before it's too late. From time to time, you see people driving without headlights. And I've wondered why. Perhaps they begin driving in the daylight, and then as it gradually gets dark, they begin to rely on street lights or other car lights, and they see just enough to be able to drive. They don't even notice that they're driving with headlights. Without headlights, they're completely oblivious. Perhaps you felt this way in a business setting. Perhaps the lights from the other cars are competitors. Some business owners, some CEOs have just enough information that if they add this and subtract that and adjust something else, they kind of know what's going on and can make the business function in good times. Well, what happens when difficult times come? Perhaps a decrease in revenues, lower margins from competition, or a pandemic hits. So many of the companies spend all of their time looking backwards, and oftentimes it is at poor quality information. You must change your mindset from rearward thinking to forward thinking. While what you did last month and last year is important, is it not more important to know what you will do next month, next year, or for the next 3 to 5 years? We have a number of desired takeaways from today's presentation. First, what we are not going to attempt to do. We're not going to attempt to turn you into a CFO unless you currently are a CFO. And despite the importance of the CFO in the C-suite, only you as a CEO can do what you do. So surround yourself with people that fill the voids and also complement what you do. Takeaway number one, we want to help you change your mindset, move from a rearward facing to a forward facing perspective, move from a firefighting mode to a fire prevention mode with respect to running your business. Number two, evaluate your current financial team. Could it be that you're not getting the information that you need to effectively run your business because you don't have the right players on the team? Or perhaps you have the right players, but they're in the wrong positions. Number three, expand your awareness of the key financial tools that will help you make better decisions. The tools we will discuss will help you become more proactive and ultimately more profitable. These tools should also help you evaluate your financial team and or have a list of tools that they should be able to improve upon. And four, lastly, think about your business with the end in mind. What is your exit strategy, either for the business or you personally, and how will you get there? Now, we recognize that companies participating today can vary significantly in size. So the impact of what is presented today will depend a lot on your company size and the sophistication of your finance teams. If you are fortunate enough to be fully staffed with the right people in the right positions, providing all the right financial tools, this may be more of a confirmation of what you are doing well than what you need to do differently. And finally, all these takeaways or desired takeaways are intertwined, and we may return to touch on some of them more than once. As we all do, we have learned a lot through trial and error and through many successes. We have been able to organize a formula that we believe breeds success. We are big believers in formulas. In math, when you apply the correct formula, you will always, 100% of the time, get the right answers. Our managing partner and founder, Jerry Vance, tells a story of his oldest daughter, Brooke. Years ago, she expressed a desire to play college basketball, and she named the schools that she had a desire to play for. Not surprisingly, they were all Division I schools. Jerry said, that's great, Brooke, but I have a concern. Brooke said, what is that, Dad? Jerry said, you're only practicing an hour or so per day, and Division I is highly competitive. If you want to compete at the highest level, you're going to need to practice 3 or 4 hours per day and do so with some major competitive intensity. Now, I don't care if you play Division I basketball. I don't care if you play junior college basketball or if you don't play basketball at all. But what I don't want to have happen is for you to expect a Division I outcome after applying a junior college formula. Fortunately, Brooke was able to make the proper adjustments and earned a scholarship and position on the basketball team. Now, I don't want to put Brooke into the witness protection program, so all I will say is she is one of the tall blondes there in the back center of this photograph. So why is this any different in business? Have you noticed that the same people continue to have one success after another? That's because we believe they understand enough of the formula to drive success their way. They may not understand it perfectly, but they understand it well enough given the environment they are in. As we saw in the prior slide, there are formulas for successful sales and marketing, for customer service, for development, for operations, etc. There's also a formula for successful accounting and finance, and that's what we intend to share with you today. In our formula, there are 3 parts. Number 1, as we've discussed, change your mindset or perspective. Move from a rearward-looking perspective to a forward-looking and forward-thinking perspective. Number 2, get the right people with the right skills in the right positions. And 3, set expectations to receive and manage with the tools we will discuss in this presentation. An important part of having a forward-looking mindset is building your business with the end in mind. Have a long-term perspective. What is your exit, either for your company, you personally? Do you plan to sell? Are you building a lifestyle business? Do you want to go public? Do you want to turn it over to your employees through an ESOP, which is a noble goal, very difficult to implement, very rarely used? Well, implement tools and strategies that will help you build your business so that you can achieve your desired exit. After all, the shortest distance between 2 points is a straight line. The sooner you determine what the end looks like, the sooner you can build your business in that straight line. So I'd like to share with you a real world story from one of our clients. We were introduced to this client by a business leader, and we began work in January of this year. By very brief background, they're approximately a $28 million e-com company. They're growing, they're profitable. They were impacted by COVID like almost all companies. So we began work in January this year. I followed up the end of March, about 60 days into the engagement, and asked how it was going. The CEO responded, well, we're tracking up 121% in Q1 quarter over quarter. He said, I saw supply chain problems coming, and we were able to bring in inventory early that we knew that we would need. This means that we have the inventory while our competitors do not. We intend to capture market share. We also own the inventory at a lower cost, and therefore we will be more profitable as it is sold. And by the way, I should mention that they are in the durable goods business. They're not dealing in fresh fruit. I believe that most professionals would look at these decisions made by the CEO and compliment him on his foresight. And when I asked, so what have we, preferred CFO, done right in the last 2 months? The CEO said, quote, thank goodness for Eric, my CFO. If not for him, we would have been seriously expletived come summer. Company ending event, end quote. I said, are you being over dramatic? He said, perhaps, but I don't think so. So in the download available at the end of this webinar will be the sample company financials. There'll be 3 documents. First one will be the income statement for this company. The second will be the balance sheet. We'll talk about the third in just a moment. Now, these are actual financials, but they've been consolidated and simplified to hide the company and protect confidential information, and also to help us focus on the highest level of information. If we were in one of the many workshops we conduct, we would individually review these documents to let the participants test their CEO detective skills. In the interest of time today, I will ask you to trust our summaries, but if you would like to download them at the end, you're welcome to wargame them yourself. And if you have questions you'd like to go over, I'd be happy to do that with you one-on-one. So the first of the 3 documents is the profit and loss or the income statement or statement of operations. We believe this document reveals that their sales are seasonal. Their sales year over year were flat, but gross profit was up from 23.4% to 25.5%. Selling fees were down 5%. That's also very good. Some expenses were up, some were down, but overall their expenses were up 24% in 2021 over 2020, and their net income was down 41%. Much of that was due to COVID. The balance sheet is the second document, and we believe the balance sheet will show you that their assets are up by about $5 million. Their inventory increase that was strategic is $5.4 million of that, which is a 470% increase. Their liabilities were up that same roughly $5 million. The retained earnings were up 2x by up $1.34 million, which is great. And their shareholder equity was up $132,000. And that was after paying themselves in shareholder disbursements 3 times more than they had the year prior at $658,000. Again, having conducted webinars with these, we have yet to find anyone that has pointed out any deficiencies that would indicate a company ending event. Both the income statement and the balance sheet combine to show a profitable company that reflect the challenges of the pandemic and also the actions the CEO took to get ahead of supply chain issues and the cost of goods increases. This is all good. So what is this business ending event that the CEO claims the CFO revealed? Well, let's look at the third document in this potential download, the CFO created cash projections. There are 2 versions. Let's focus on version 1. And again, this is a consolidated document. The full document of cash projections is week by week. So this version was created in Q1 of this year. And I'd like to focus on the available cash lines and the line of credit. They have a $1.9 million line of credit. And in first quarter of this year, they had drawn down $1.75 million of that. The company ending event, according to the CEO, would occur in June, last month of this year, and July, when they exceeded their ability to meet their obligations by $443,000 in June and still remaining $250,000 beyond their capability to meet obligations in July. The CEO had no headlights to be able to see into the future when he made his supply chain decisions. He said everything just felt right. and from a strategic standpoint, it probably did. He claims there was no available avenue to address the shortfall and preserve his critical relationships in June and July. And this is only one example of a forward-looking vision that a CFO should bring to the C-suite. Now, version 2 in this was one of a couple of scenarios that were planned and suggested by the C team and led by the CFO. And it was to increase cash by running some early promotions to convert some of this inventory into sales and to cut expenses. And I'm happy to report that they made the changes, and without fully drawing down their line of credit, they met their obligations last month in June and are on track to do so this month in July. So the last exercise took us into tools, but it was really about being forward-looking, that mindset issue. It does you no good to change your mindset to be forward-looking if you don't have the team in place to be able to execute. You need a team that has the horsepower to help you, the CEO, move from historical to forward thinking. So the second takeaway is to evaluate the capabilities and deliverables of your financial team. Do you have a hard time getting answers to simple questions like in this cartoon? The key to receiving this vital information is to have the right personnel with the right skills in the right positions. Again, the only way to successfully become more forward-thinking is if you have the right staff in place. It takes a sophisticated staff to become more forward-thinking. So many business owners are frustrated because they aren't getting the essential historical and future-looking information they need to effectively run their business. Understanding the differences in these 4 primary positions in the financial team will help you better understand why you are receiving or not receiving this critical information. So the bookkeeper, that's your daily transactionist. They deal with accounts receivable, accounts payable. They may do the front end or the complete processing for payroll. Their thought process is cash basis, cash in, cash out. The CPA is almost always outsourced unless you have a business of sufficient size and tax complexity that you need a full-time tax strategist. Their job is to keep up on current tax laws, to develop a tax strategy, to help you file your taxes, and to help you through an audit if audited. Their goal is to help you pay the least amount possible legally in taxes. Your controller is your historian. They are the taillights in the analogy of the car with the headlights. They're responsible for your financial statements. They're responsible for your record keeping. They should be thinking about this in terms of accrual accounting rather than cash accounting like the bookkeeper. And lastly, the CFO. The CFO is your forecaster. They are your headlights. They help you assess risk. They help you prepare for the future. Recently, a business leader offered the following analogy of a controller versus a CFO. He stated that the controller is the individual standing at the back of the boat, calling up to the bridge that everything behind them looks great. The CFO is standing on the bridge next to the captain, helping he or she navigate around obstacles and steer into the future. Another leader teaches his groups that C equals 3. In other words, if you have a C in your title, you should have a mindset of 3 to 5 years into the future. Of course, then the question is, what is the mindset of your C-suite members and also of yourself? When we dive into businesses to see what's going on, we usually find one of 2 things. They have skilled people, but they're in the wrong position. Sometimes companies have an excellent right fielder, but he or she is playing shortstop, completely out of position and missing way too many ground balls. The other problem we find is that they have underskilled people on their team that need to be properly trained or replaced. Many smaller and even mid-sized companies can't afford a high-quality CFO, so they promote someone that isn't qualified, or they hire a controller and call them their CFO. Let's be real, it may be difficult to have major league players if you're not dealing with a major league revenue stream. Many smaller companies simply can't afford a CFO at $300,000 or $350,000 or more per year. Rather than promoting someone that isn't qualified or hiring a controller and calling them their CFO, companies would be better off engaging an experienced part-time CFO. After all, you don't need bodies, you need knowledge and experience. In this example, most of us would prefer the water skier on the right. Once business owners get the right people in the right positions, they can and should expect consistent delivery of the essential tools and deliverables we will discuss. It has been said there are three types of CFOs, those who can count and those who can't. Slow burn joke. Again, controllers and CFOs have very different mindsets. Controllers are historical facing and CFOs are forward facing. Make sure you aren't asking your controller to play in a position that he or she is not skilled to perform. We were introduced to recently to a potential client. They explained that their loyalty to their employees was an important part of their culture. Their CFO had been with them for 38 years, starting as a bookkeeper. 2 years earlier, they had promoted that individual from controller to CFO. They had backfilled that controller position. So I asked, why were we introduced? Why are we having this conversation? They explained that the controller turned CFO was failing as a CFO, but the new backfilled controller was doing great. And now they needed to release this 38-year employee, and they needed true CFO leadership. In this case, their dedication to team members backfired. In every position, you need to set proper expectations as to what you want them to deliver and assure that they have the skills to be able to deliver. The most common financial team challenge that we find is a controller with a CFO title or a CFO with controller level experience and skills. So how do you know this? First, did you hire or promote them? Why? Well, if you promoted them, then you should understand and know what skills they added or training they received in order to be able to change that mindset from historical to forward facing and to be able to deliver a different set of documents. And then, of course, can they deliver the forward facing tools that we're about to discuss? So as we transition out of teams and into tools, in our extensive experience, this is the list of how these tools are divided into controller and CFO responsibilities, and we'll identify each as we go through those. So as we wrap up this section, think of your team members. Do you have the right people with the right skills in the right positions to move to a forward-looking perspective? What changes, if any, do you need to make? Now stick with me on the next group of slides. They remind me of the story of the woman who went to the doctor and was told she had only 6 months to live. "Oh no," said the woman, "what shall I do?" "Marry an accountant," said the doctor. "Why?" asked the woman. "Will that make me live longer?" "No," replied the doctor, "but it will seem longer." Financial tools are not sexy or exciting, but they're absolutely critical to understanding your business and managing and growing it in the most effective and efficient way possible. Each of the essential tools I want to discuss fall into one of three time periods: near term, midterm, and long term. How are you going to comply with your immediate obligations and get through the near term or the next 3 months? This should be spelled out in your near term plan. What is your midterm plan, and how are you going to drive the business forward over the next 12 months? What is your long-term plan? What are your long-term goals? As discussed earlier, are you building a business with an exit strategy in mind? Have you taken into consideration any outside capital you might need? How are you going to build a real business with a reasonable, if not high chance of success and reaching your goals? If you don't have a good plan in place for your business with the end in mind, isn't it just a hope and a dream? Remember the analogy of the car looking forward, the need for headlights and how to safely make lane changes. To safely and confidently navigate, accelerate, and ultimately reach the destination or the goals, we believe there are 6+ essential financial tools that every CEO must have. They are accrual-based financials, budget to actual reporting, cash projections, a 12-month budget, a rolling 12-month forecast, and 5-year projections. And that is projecting not only the profit and loss or income statement, but also the balance sheet and cash projections for 5 years. And then also as perhaps a suite of analytical tools to help you analyze the financials. The first of the 6 essential financial tools is accrual-based historical financials. This is managed by the controller, certainly should be overseen by the CFO. We are continually surprised at how many companies are on cash basis accounting. Usually this is the first correction that needs to be made. In most situations, you need to have accrual-based financials in order to understand and run your business. By way of example, let's suppose you started a new business on January 1st, and in the month of January, you booked $100,000 in revenue. February 1st, COVID-19 hits, and your business is completely shut down. But during the month of February, you receive the $100,000 in revenue that you generated in January. You collect that. Well, according to cash-based accounting, January was a terrible month, but February was a great month. But that's not what really happened. What really happened was what accrual-based accounting will show you, that January is a great month and February is a terrible month. And you as the CEO may say, hi, I'll remember that. But the reality is the months click by and the years click by, it gets lost and you don't remember those details. Also, if you're going to share information with outside groups, whether it be bankers, lenders, investors, or a potential acquirer, accrual-based accounting is essential for that communication. Your financials should be prepared properly so that they're GAAP compliant, audit ready, and most importantly, provide good management information to run your business. It's best achieved when they are accurately presented in a monthly side-by-side view with comparisons to comparable periods of the prior year and against the budget. So we'll discuss that budget actual report in more detail in a few minutes. But seeing monthly financials presented in such a way that they show the trailing 12 months is also critical. This will allow you to identify problem areas that need to be addressed before they become serious. So you need to clearly understand the gross profit margin, contribution margin, and EBITDA margin. We find that most small and mid-sized company CEOs understand gross profit and EBITDA, but few understand contribution margin. And contribution margin is key. So revenues less direct cost gives you gross profit. Gross profit less variable expenses give you contribution margin. It tells you for every dollar in revenue that you bring in, how much will go to cover fixed expenses and profitability. So marketing people are great at inventing terms to reflect ROI or to deflect ROI discussion. So what is the ROI of our marketing? There's an increase in brand awareness and brand affinity and brand sentiment and brand engagement. Well, how about in terms that I can understand, like EBITDA? It sounds like you just made that up. So this is an example of an income statement that was not prepared on an accrual basis. See how the gross profit goes up and down? One month it shows you're very profitable, the next month you're losing money. This is the result of a cash basis accounting. However, if you're on accrual basis accounting and you've experienced these up and downs, then there is a serious problem in your business that needs to be addressed. Number two is budget to actual report. And it implies that there's a well thought out budget in place. And we'll get to the 12-month budget in just a minute. This is one of 3 12-month tools and should be supplied by the controller because it's historically based. The budget to actual report compares monthly results to the budget previously established. It may include not only the income statement, but also the balance sheet in this budget to actual comparison process. Why it matters. The budget to actual process is how you begin to establish accountability and set a standard of constant improvement throughout the company. It helps team members understand what is expected from them and tracks and reports their performance. It facilitates the difficult conversations. For example, was it a good month or not? I don't know. What was the budget? How did the results compare to the plan? And what can be done to improve? As the saying goes, what gets measured gets managed. By reviewing each line and seeing how it compared to your expectations, you'll gain a better understanding of your finances and have a chance to make course corrections. If your sales were lower than expected, you need to hustle a little more. Maybe you should run a promotion to create more sales, or maybe you need to raise your prices. The budget versus actual report won't necessarily hold the answers for you, but it will let you know what areas of your business may need a little extra attention. Similarly, if your month was better than expected, how did you do it and how can you do it again? Were you better at keeping costs down, or did you find that perfect price point that heated up sales? Do a little detective work to figure out what worked and put some systems in place so that you can do it over and over again. So this is an example of a budget to actual profit and loss. And in this example, we have a budget to actual for the month of July and also year to date. So we have a client that has used the monthly review and budget to actual review process as a way to establish accountability and set a standard of improvement across the entire company. They have been with us since our inception. Every month, this company is consistent at improving. They seem to have a record month almost every month. It is crazy. Sometimes our CFO meets with the CEO, expecting the CEO announced some big trip for the management team to Hawaii or something. But instead, they drill down as a management team to find ways to improve. They are drilling down on every product line that showed even the slightest signs of weakness. Now, I'm not saying you shouldn't reward the team. That's an area where this company could probably improve. But what I am saying is be relentless at improving your business every month through your review and comparison process. Cash projections. This is somewhat different than a cash flow, although the terms get interchanged quite often. Cash flow is where the money went that is historical. Cash projections is a look into the future and is managed by your CFO. It's a near-term financial plan for running your business, typically referred to as a 13-week or 3-month cash flow. And it may be partially prepared by the controller, but she should be overseen by the CFO, since this is one of his or her most important responsibilities. Why it matters. This is where the rubber meets the road with respect to weekly cash management. How are we going to pay the bills? Current cash balance plus collections must exceed required cash disbursements. It is granular and breaks out cash receipts by customer and cash disbursements by vendor. Use this to determine when and how you will pay current bills. It reveals potential cash shortfalls before they occur. It projects how different decisions will impact the ability to meet obligations. Some companies think that this by itself is enough, but it's only a short-term fix. It must be done in conjunction with historical and mid and long-term planning. It is possible that you can manage your short-term cash needs over a period of time while driving your company deeper into the ground because you're consuming assets. Perhaps you have a profitability issue or collections issue or some other problem that needs to be addressed. So this is a sample of a cash projection. We certainly saw a real-life example in the scenario that we reviewed earlier. It shows where your cash flow shortfalls are and when they may occur. Number 4 is a 12-month budget. A 12-month budget is your midterm plan for your business. It is also a forward-looking tool and predominantly set and managed by the CFO. It's like setting your financial goals or your New Year's resolutions at the beginning of the year for the upcoming year. It's your stake in the ground. It typically does not change as the year progresses. Should be set annually. So prepare a plan for the upcoming year, and it should include not only your profit and loss, but also your balance sheet and your cash projections. It should be reasonable, realistic, and achievable. Most importantly, it should be measurable. It's hard to manage something you cannot measure. Why it matters. Because the 12-month budget does not change month to month. It becomes the reference for direction and performance throughout the year. It is the foundation against which the budget report is compared. It helps to facilitate optimal resource allocation for each period. It allows your company to make detailed plans to operate within its means. It communicates asset availability to different individuals and departments. And budgeted expenses are not a surprise. This is a sample budget from a larger P&L. Hopefully we all know what a budget looks like. Number 5 is the rolling 12-month forecast. This is the third of 3 12-month documents. The rolling forecast should include the balance sheet, the income statement, and the cash projection. Unlike the annual budget, the rolling 12-month forecast is updated monthly with actual financials and the latest information. This provides mid-term cash out information. Due to its forward-looking benefits, it is best managed by the CFO. Why it matters? Because it reflects changes in the market and/or the company's operation, improved decision-making confidence throughout the year. It allows management to react to significant changes with the latest information and to be in an athletic position to respond. It reveals possible changing financing needs for the next 12 months. It ensures operations for the next 12 months, and it shines headlights on the next 12-month period. This is an example of a rolling 12-month forecast. This is the balance sheet portion, and it shows actual for the prior month and the forecast for the next 12 months. And it shows actual and forecast for the current year and forecast into the next year. Number 6, the 5-year forecast. The 5-year forecast is the roadmap for the future. It provides long-term, forward-looking vision and is created and managed by a strategic CFO. The 5-year forecast is in the same format as the 12-month rolling forecast. It includes not only the forecast income statement, but also the balance sheet and cash projection. We like to forecast in a best case, a worst case, and expected case scenarios. It is a financial blueprint for building business, your business. It is a rendering for management and investors for your business. And it is a plan for your long-term financing needs. Your 5-year forecast is your headlights for that long term. It predicts revenue, expenses, profit, and most importantly, cash requirements for the next 5 years. It provides management with greater confidence to make the right and the big decisions today. It projects the future value of the company based upon those decisions. It anticipates financing needs before they occur. And it aligns and should align with the company's plan and strategy. It helps you be in an athletic position for outside financing or an exit. And more importantly, just run your business. Let me share an analogy. For those of you who have played or watched baseball, you should be able to relate. Imagine standing in the batter's box waiting for a pitch. The ball is coming so fast that you have little time to make a decision to swing or not. Therefore, you have to be in the motion of swinging before the ball even leaves the pitcher's hand. As the ball gets closer, you make a last-minute decision to follow through with the swing or to pull back. This is very applicable to business. We have a former client by the name of Smart Rhino. They engaged us to clean up their accounting and build their forecast, etc. Because they had all the tools in place, they were in an athletic position. And we helped them through a very good, but very unplanned acquisition. But they were in an athletic position to be able to take advantage of that opportunity when it unexpectedly came. Why not always be prepared or in an athletic position for an acquisition? And be prepared for raising debt or equity financing if such an opportunity is required or desired. Be prepared for an audit. And most importantly, for providing quality and actionable information for running your business. Business and life in general are better when you're in an athletic position and prepared for whatever life may throw at you. So this is an example of a 5-year forecast. It details current month actuals, current year actuals and forecast, and then extends that forecast into the next 4 years. Just like driving a car, how foolish it would be to accelerate down a road without consulting your near-term, mid-term, and long-term plans. This will eliminate blind spots, illuminate the road ahead, and help you safely make lane changes. The 6 critical financial tools, which we have listed earlier, are essential daily tools. The next group are some of the analytical tools we believe each CEO should have access to in order to increase revenues, maximize profits, and ultimately increase shareholder value. Some of these tools are used regularly, some are used occasionally. The following are quick samples of some of the tools that we recommend that CEOs and their financial teams be aware of. Product line and contribution margin analysis. Which products or services contribute most to a company's success? Which should I grow and which should I minimize? The contribution margin analysis tells you how much does each dollar in revenue contribute to the company's overhead and profit. This will help you understand which products are most profitable and where you need to make adjustments. Perhaps your best-selling products are your least profitable products, and your lowest volume products are your most profitable. Understanding which contribute and how much it contribute to the bottom line is important to know where to put your emphasis and to grow your business. Break-even analysis. This happens to be in units, also available in dollars. How many widgets or units or how much revenue in dollars must you deliver to break even, whether you're starting a company or whether you're starting a new product line? Again, same break-even analysis. The prior one was in units. This one is in dollars. Revenue bridge. Reviewing top-line revenues of your business can tell you that your business has experienced growth, but it won't tell you what's driving the growth. Revenue growth is driven by changes in price and in volume. A revenue bridge will help you better understand what is driving your revenue growth. If you have raised money through equity, or you are going to raise money, a cap table or a summary cap table is important. You need the advice of an attorney. You need the advice and experience of a good strategic CFO. Certainly, if you're giving up equity, you're raising money, you will have a smaller piece, but you hope it's of a bigger pie. So there are 3 quick slides here. It just shows dilution the founders will experience as they give up equity through different money raises. There are some important terms that CEOs generally will not be familiar with, but the investors are very familiar with: participating or non-participating, liquidation preference. In this example, the founders ended up owning 38.2% of the company, but they only got 27.5% of the proceeds in the sale or liquidation. And that's because the investors knew more than they did in this process. A good CFO that has experience in money raise will make sure that you retain as much of the equity and the proceed distribution as possible. So knowing what you know now, what is your action plan? Which tools are you missing and need to implement? How are you going to take advantage of the expansion opportunity or weather a challenge? So thank you for taking the time here today. There will be opportunities for companies to pivot and lead out in their respective industries in this ever-changing economy, and we hope that is you. This concludes my formal presentation. I'm open for Q&A. My contact information, as well as that of our founder and managing partner, Jerry Vance, is on screen, as well as our website location. There's also a download site where you can download the assets from today's webinar. They are the 3-page sample company documents that we referenced in our earlier activity. There is a 3-page PDF of the key takeaways and why each one of those are important. There'll also be a single page that talks about who we are, what we do, and we'll offer a free pro bono consultation to anyone affiliated with CEO Coaching International. Heidi, do we have questions?
We do, Scott. Thank you so much. We have a few questions, and there's still time if anybody wants to put their additional questions in. There's still time, so please feel free to do that. The first question is, can a controller become a CFO, and how?
Very good question. And I mentioned that's one of the major challenges we find when we are asked to dive into certain companies. The answer is both yes and no, and it really depends upon the individual. So there's a difference in mindset. We're familiar with a number of the mental mapping technologies that are out there. One of them is the Ned Herman whole brain model, and that goes in and through a series of tests kind of determine the mindset of the individuals and groups them into color codes. You know, you got the CEO that is very high level thinking and is willing to take on some risk. You've got the HR manager who is very people oriented. But in this application, the grouping for a controller is someone that is very comfortable with numbers, but numbers are their friends. They know that 2 + 2 always equals 4. And then you've got the CFO that is also very comfortable with numbers, but they're willing to play what-if games with those numbers. So it's kind of a cross between the controller and the CEO, makes a good CFO. Many controllers have that mindset. They just haven't had the experience or the training or the mentoring to really change their mindset from historical, always the same 2 + 2 = 4 to forward facing and explore different potential outcomes. If they have that mindset, then they need training, they need experience, which really comes in the form of mentoring. We've also found certain controllers that regardless of how much experience they have to forward facing strategies, just can't get away from their comfort level that 2 + 2 always equals 4, and they can't change their mindset to be forward facing. So it's both a yes, no answer, and it really is dependent upon the individual.
Good info. There's a 2-part question here. Somebody had said that they wanted to understand the budget and forecasting tools, and I just want to highlight that I put the link to those in the chat. And somebody else just asked, which analytical/dashboard tool do you suggest using? Power BI, question mark.
Okay. The answer to which analytical tool we recommend is really dependent upon the systems you have, both for accounting and if you have an ERP system, you want one, and also the industry you're in. You want one that integrates with your current systems. We like to work in Excel because it's so easily able to be drilled down into, and it's understood by almost all business professionals. But there are a bunch of KPI tools out there, dashboard tools, and we really like to align that recommendation with the tools that you're already using to run your business. I think the other question was about keep me on track here. What was the first part of that question?
The budget and forecasting tools, which I put the link to.
Okay, perfect. Thank you.
Absolutely. Next question is, what are the differences between the 3 12-month documents?
Good, thank you. Yeah, I would present them maybe a different way. We presented them in the 1 through 6 format because they were first the controller or historical based documents versus the latter CFO documents. But the 3 12-month tools are an annual budget. Generally, that's the one you're going to set first. Really forward looking. That is the stake in the ground. It doesn't change. Think of it as your New Year's resolutions. If you want to go to the gym for an hour 5 times a week on January 1st, you probably still want to be doing that on December 31st if that's your plan. It's also the one that you will use to communicate to your different individuals and departments what their asset availability is for the year. So again, that's an annual budget. It should remain fixed through the year, excepting extraordinary circumstances. The second one is the monthly report against that budget, the budget to actual reporting, and it shows how each individual, how each department, how the company's performed against the original budget. And then the third is a rolling 12-month forecast. It's in the same format as the 5-year forecast, but that's where the changes that are enacted upon the company or the economy or by product lines, whatever changes you're experiencing are reflected. And so it's always rolling forward a month at a time, even though it's for a 12-month period. And that gives you the ability to respond to changes in the marketplace or changes in the competition or your company. They're all 12-month documents, but each one have a specific purpose.
Great, thank you, Scott. Next question is accrual accounting always better than cash accounting?
Okay, good question. There are some industries where they are nearly similar. And essentially, if you are invoicing for services or goods delivered, and you're collecting for those same services or goods delivered in the same month, then cash and accrual accounting are going to show exactly the same information. However, if you're generating revenue that you're going to collect on at some point in time in the future, and it's not within that same month, then accrual accounting is really required to be able to show what's truly happening in your business and to be able to communicate that activity and that health to outside parties, be it bankers, investors, or potential acquirers. And the longer your lead time is from revenue generation to collections, the more important accrual accounting becomes.
Awesome, thank you. And this will be the last question unless somebody has another one that they want to put into the chat, which we're happy to answer. The next question is, how do I know if I need a full-time CFO versus a part-time CFO?
Excellent, good question. It really is hours based. So, you know, and of course it's assets or revenue, your ability to pay for that individual. Like in all other occupations, we're seeing salaries increase quite dramatically. We occasionally reference the website salary.com. We think their estimates of what people are worth are really quite overinflated. It's almost alarming when you go in there and put in your zip code and you put in the position and then the levels of experience if you want to dive into it that deep. But you know, a good CFO is going to cost you twice what a controller is going to cost you, and a good controller is going to cost you twice what a bookkeeper is going to cost you. So we are seeing some amazing salaries out there for experienced qualified CFOs. If you can afford a full-time CFO and you can keep them engaged full-time in CFO activities, then you should probably make that investment. But if you're hiring a full-time CFO and paying them wages and they're spending half their time doing controller level activities, your return on investment would be much greater to have a good, solid full-time controller, and then overlay a part-time CFO strategist to help that controller not only mentor them, but deliver the tools that you need as the CEO of the company. So really it's hours based, but make sure when you're looking at the hours that you're looking at true CFO functions and not controller or bookkeeper functions. We had a conversation with a potential client a year and a half ago. The CFO had been with the company for 30 plus years, and we asked the CFO about these 6 tools that they were delivering, and he admitted that he hadn't been delivering a 5-year forecast to the management team for some 20 years. And we asked why that was, and he said, well, our HR manager quit, so on a part-time basis, I took over HR functions, and we never replaced that individual. And then we had some changes at the controller level, and the person we hired was not a true controller, so I took on some of those responsibilities. So they had a very well-tenured, well-seasoned CFO, but they were no longer really performing CFO functions with all their available hours. So the company was spending more for this individual on a per-hour basis, if you think of it that way, than what they really needed to be. So and we can help you evaluate that. It's certainly transaction-based. The complexity of your business is important in determining what is that right balance between part-time and full-time. And that applies not only to the CFO level, but to a controller level as well.
That's really great information, Scott. Thank you so much. And thank you for putting this together and sharing it with our audience. I thought it was really interesting and useful, and I appreciate you sharing with us.
Absolutely. It was a pleasure to be here. Thank you, everyone, for attending. If I can help in any ways, one-on-one, if you have questions that were not addressed here today, please email me or feel free to call me. I'd love to speak with you.
Great. Thank you so much. Thanks, everybody. Bye.